Welcome everyone to this week's speaker series. Happy to be joined today by Lisa Hornby, head of U.S. multi-sector fixed income at Schroders. Lisa, thank you for joining us this week.
Thank you for having me.
Great. So Lisa, you kind of overview there at Schroders several, I guess, all the different strategies that have to do with fixed income, mostly focused in the dollar-denominated world. Maybe start us off with if this year has actually gone how you guys expected it to be, or have things been that much worse than fixed income space? We know that investors are, especially fixed income investors, are sitting on massive losses. We're talking 2-3 standard deviations from the mean Z-scores on fixed income all across the board. So maybe give us a quick rundown. How has the beginning of the year sort of evolved vis-a-vis your expectations going in?
Okay, well, that's a big question, but try to break it down a little bit. So the first question is this what you expected? I would say we expected significant volatility this year because our kind of the main theme for us coming into the year is that financial assets have benefited from a tremendous amount of liquidity over the last several years, and that liquidity was being withdrawn. So our view was that risk assets would come under pressure, but to be completely frank with you, I think the degree of pressure and how fast it all happened was a bit surprising. I think it's probably caught most market participants off guard. The magnitude of the rate sell-off as well. We started the year short duration in our strategies that could go underweight duration, but we covered it in retrospect too early. The sell-off continued. So I would say it's been pretty aggressive. And when you look at the quarterly returns in fixed income across a variety of indices, what you see is that this has actually been the worst or second worst quarterly return since most of the fixed income indices were incepted. So we're looking back 30 or 40 years, and you see that this is the bottom, percentile or second worst percentile. I guess the positive interpretation of that now is that there is now much more attractive opportunities in the asset class today than there have been in many, many years. And we say that both on the rate side and the spread side, because we've seen both of them come under significant pressure thus far. So I'm sure we'll get into that as we speak through, Ahmad.
Sure. Yeah, no, and look, you could be forgiven for that. I don't think most people, most strategists, most PMs, most investors really had a major land war in Europe on the radar to start the year. So we definitely know that has exacerbated the inflationary pressures around the world and have added to the growth concerns, which is a toxic mix for monetary policy and for fixed income. Why don't we take a step back here, Lisa? Maybe give us your sort of broad US economic views, because we always like to start with the fundamentals, with the economy. How do you see the US economy right now? The big question out there, you're sort of seeing it every day in terms of headlines. What are the risks for recession in the United States, and what are your views on that?
Yeah, so that's the big question now, and I think the market is right to start questioning the growth dynamics and how sustainable the growth outlook for the U.S. is. Our base case is that we don't have a U.S. recession in the next 12 months, but we are very conscious that the tail risk of one is rising, and regardless of whether we think we're going to have a recession or not, the market may start discounting one. So those are the things that we're grappling with. The reason we don't foresee a recession as our base case right now is because the U.S. is starting from a relatively strong point. The U.S. consumer has still about $2.5 trillion worth of excess savings on their balance sheet. People are employed, people are making money. The same is true for corporate fundamentals. We look at corporate balance sheets, they've actually delevered over the last couple of years. Interest coverage is high. So we're starting at a relatively strong point. However, we are starting to see cracks underneath the surface. Now, that doesn't mean cracks don't mean a recession is imminent, but cracks do suggest that there is certain pockets of the economy, and most notably the interest rate sensitive sectors, are coming under some pressure. So when we look at certain leading indicators, so things like the manufacturing PMIs, they tend to be a bit more responsive to interest rates. We are starting to see them come down, again, from high levels, but no longer expanding at the rate that they once were. When we look at signs in the housing market, we're seeing that, unsurprisingly, 5.5% mortgage rates in the US and 20% home price appreciation over the last year is starting to bite. So earlier this week, we received the National Home Builders surveys, sentiment surveys. It looks at things such as foot traffic, prospective buyers, and what you see is that that data has started to slow pretty dramatically as well. Now, again, this is all starting from a strong point, but what I would bring to your attention is that this is an economy that's in transition. It's an economy that is being hampered intentionally by the Fed, who is withdrawing liquidity by raising rates, by reducing their balance sheet. And it's an economy that's being hampered by very significant inflationary pressures. And until those inflationary pressures come down, the Fed is going to continue to be fairly aggressive on the rate hiking side. And that's where the challenge comes into play for risk assets in particular.
Right. No, those are all very good points. We also see strength in consumer and in corporate balance sheets, but like you rightfully said, the housing sector has become a problem. Actually, we're looking at some numbers yesterday. The cost to a buyer for the median value home in the United States has increased by 50% over the last 6 months. So that's a significant decrease in home affordability. So we definitely see weakness or some weakness in the U.S. housing market. Let's touch on that quickly, because I'm sure you also look at MBS, another type of housing debt. Do you see the weakness in housing that we're sort of seeing coming down the line? We think the numbers, the sort of recent numbers we've seen on the real estate side, are only kind of going to get worse. How much worse do you think they're going to get? Do you think we're going to get let's say a rapid enough slowdown in the U.S. housing sector that it could become a problem for the overall economy?
So I think the answer to that is probably not, but the strength that we've seen is probably behind us. Mm-hmm. There's inventory in the housing sector is still relatively low. So it's not like there's tons and tons of supply that's coming mm-hmm. online, or that's forecasting to be built, maybe in certain pockets, but not in the aggregate. But I think that the strength that we've seen is probably now behind us, and from here on out, it's more of a maybe slight slowing, or things stay a bit more stable. I think the reason that that's significant, though, is because typically when you see a significant amount of demand for housing, you also get a lot of spending that goes along with that housing. People buy a new house, they have to go buy the furniture for that house, they get the paint supplies, and there's a lot of ancillary multipliers that go along with it. So, oftentimes the direction of U.S. housing in the U.S. is the direction of the U.S. economy. It tends to be a very strong impact. If you start to see that slow, then some of those multipliers also start to slow, and that that potentially has a follow-through impact on the overall level of growth. Again, we think growth is slowing. It's probably not recession-like, but it's certainly coming off the peak levels that we've seen over the last 12 to 18 months or so.
Okay, and I'd like to take this moment to remind everyone that should you have any questions for Lisa, as soon as we finish our discussion, we're happy to take questions from the audience. So please submit them via the chat, and I'll be happy to read them out to her after we finish our brief conversation here. Lisa, now that we sort of got your overview on the macroeconomic picture, at least in the United States, care to share any views outside the United States, perhaps Europe or some of the major regions of the world?
Yeah, so my opportunity set is predominantly U.S. markets and U.S. specific, but just a few comments. I do work for a British firm, and I was over in London a couple of months ago, and I would say that the mood over in Europe is much more bearish than that in the U.S. And now maybe things are starting to, and exactly, that's exactly the point I was going to make. Things here maybe are starting to get a little bit more concerning, but the proximity to the Russia-Ukraine situation and the resulting sensitivities on oil and gas prices is much more acute the closer you get to the actual geographic problem that we're talking about. And so I think that there's much more significant concern, but from my colleagues abroad, about the recessionary outlook in Europe. The UK is not completely insulated from that either. Maybe growth prospects, they're a little bit more positive, but still, I think the U.S. is on slightly better footing from that perspective, just given slightly more energy independence and proximity or distance from the Russia-Ukraine situation.
Right. Excellent. So let's turn back now to the United States. Given where you are in terms of your economic views, as we sit here today, Fed funds futures are implying a more or less a 275 basis point Fed funds rate at the end of the December meeting. What's your view on the forward path of monetary policy for the Fed? Do you think the Fed's going to be there? Is it going to be below? Is it going to be higher? I know a lot of that sort of depends on your view of how fast inflation can come down or not. So maybe let's kind of tackle both issues at once.
Yeah, so let's start with inflation. Our view is that inflation either has peaked or is very, very close to peaking. And there's a few reasons for that. First of all, we see some of the supply chain issues starting to alleviate. Mm-hmm. When you look at the freight and the cargo measures, so how long does it take things to ship? How much does it cost to ship things? How long are they waiting in port? We see that the worst measures probably were hit around September or October of last year. And since then, things have gradually improved. Now, still, supply chain is still not fixed, but it seems that we're continuing to see improvement at the margin. Things like the rig count, for example, continue to ramp up. Now, that doesn't, the rig count ramping up doesn't mean that we see, tons of new barrels of energy, of oil put on in the market right away, but over time that should alleviate some degree of the problems that we're seeing there. Businesses have been able to build inventories, right? We know the retailers were out talking about that on earnings over the last few days. They were successful in actually increasing their inventory. So right. That does alleviate some of those supply chain issues on a go-forward basis. Now, the second element of this
they're also going to have to drop the prices for those goods to get rid of those excess inventories, right? So that's
exactly that's exactly right. And that's kind of where I was going to go with the second point, which is that in the initial aftermath of COVID, you saw consumer spending habits change. And what changed was that people were not able to go out and buy services the way they typically did. So what did? They went out and bought goods. And now that we're in an economy that's largely reopened, people are shifting back from goods consumption to service consumption. Mm-hmm. And goods consumption or goods prices is actually where we saw the really significant inflation. Goods prices were running at 12, 13, 14% year-on-year increase. Service inflation is running above trend, maybe 3, 4, 5%, but that's a much more moderate level of inflation. So if you do see the consumer continue to shift, which we expect they will, from goods to services, that should have a moderating impact on the inflation data. Mm-hmm. And I would say the third component is that in some ways that the best cure to higher prices oftentimes is actually higher prices. If people have less discretionary spending power and ability, they can't go out and buy the same things that they were before. Obviously, more money now is going to buy food and gas, which means it's not being spent on items X, Y, and Z. And so to some degree, you kind of tie that back into the retail problem. Right. You have too many goods all of a sudden. How do you get rid of them? Well, you actually have to lower prices rather than continue to raise them. So, we are fairly confident that inflation is in the process, if not already peaked. The question is, how fast will it actually come down? And when we look at what's priced into the market, a little bit has come out the last couple of weeks, just given the market environment. But broadly speaking, when the market was pricing in around a 3.25% terminal rate, 3.25% terminal rate, in addition to balance sheet contraction. And when we look at what does balance sheet contraction mean, we approximate that to something on the order over the course of a year. We think $1 trillion in balance sheet contraction, which is what they're forecasting at the Fed, should result in an implied tightening of policy by another, let's say, 50 to 75 basis points. So that actually brings the terminal rate closer to 4%. I think that's that's pretty restrictive policy. One of the keys to our view is that the US economy has not fundamentally changed since COVID. What changed was that there was a tremendous amount of monetary and fiscal stimulus poured onto the economy. That is in the process of being withdrawn and worked through. But the potential growth rate in the US is still what it was pre-COVID, which is around 1.5 or 2%. Typically, you can say the potential growth rate and the neutral policy rate should go hand in hand. So if that's true, then the neutral policy rate should be around 2%. A policy rate of an implied policy rate of 4% is actually quite restrictive, and we do think that will work to bring inflation down. And frankly, the Fed's only gotten a couple of hikes out, and we're already seeing those interest rate sensitive sectors turning. So we do think that they will be successful in conquering this inflation problem. It's very hard to call whether it's going to come down fast enough to actually avoid the recession, which, to your earlier point. We think that they possibly can, but the risks are rising, and the impact on financial assets could still be quite negative.
Right. I was going to make a point. You made a comment earlier that the cure for higher prices is higher prices. That's as long as consumers expect those higher prices won't continue or into the future, right? Because then otherwise then becomes an inflationary spiral. But to that point, long-term inflation expectations have actually come down, especially recently. They've actually come down. They have been pretty stable. So these are some great points you make. So let me ask you this. So your view is that the neutral rate is basically where the Fed has been telling us it's going to be, kind of where the long-term Fed funds rate kind of is gravitating to. You don't think there has been a fundamental change to that neutral rate over the last couple of years?
Yeah, at the margin, maybe it's slightly higher, but not materially higher. We're talking maybe 0.5% or so. We look at some of the more structural issues with regards to commodities and what's going on now in terms of governments trying to fund various clean energy programs, and we do think there could be some more structural inflation in that pocket of the market. But when we look at the sort of overall picture, 2.5% policy rates are probably still the right place, neutral.
Okay, great. So now let's shift over to your actual portfolios. So how are you positioned now? And then this will be my last question to you before we open it up to questions from the field. How are you positioned right now? Where do you see opportunities? And what markers are you using out there as guideposts as to where you might be adding or taking risk off throughout your portfolios? Maybe give us a broad overview.
Okay, yeah. So I think the key right now comes back to we're an economy in transition, and valuations, broadly speaking, are around the middle of their longer term range when we look at credit spread sectors. So what that means for us is that we want to have some liquidity in portfolios because we think that there is probably still continued volatility ahead of us. Now, there are some opportunities in markets that are starting to emerge. One of them is the front end of the corporate investment grade credit market. I think probably the single best trade out there right now is owning 2 to 3 years investment grade corporates at a 3.5 to 4% yield. That is very attractive in our view, and that's very attractive on a historical basis. It's a place to hide out. It should be relative. The volatility in that part of the market should be relatively low. And over the next 2 or 3 years, depending on what kind of bond you buy, you're almost guaranteed to earn something like an 8 or 9% return, again, depending on how far out you go. So I think that is one pocket of the market we like. It's attractive from a carry perspective, and it's a way to earn some yield while still being in a relatively defensive part of the market. I think another one that's starting to open up, which is really sort of an unusual sector, is actually tax-exempt municipal bonds. These are bonds that typically are owned by retail investors because they have tax considerations, and these are tax-exempt bonds. But they are very high quality. They're local government authorities, and typically they trade well inside of treasury bonds because you have the tax exemption element. But more recently, we've seen certain pockets of that market actually trading well wide of U.S. treasuries.
How wide are you talking about?
120, 140, 150 basis points.
It's pretty rich, yeah.
Yeah, pretty cheap.
Sorry, pretty cheap, yeah.
Yeah, so we're looking at some of these. They're very low coupon, and as a result, their dollar price has fallen quite dramatically, and they're trading in the 4.5% yield area, which to us, typically these are AA or even sometimes AAA rated bonds. That looks really good. For as a longer term investor, which we are, we think we will ultimately be paid to take some of that risk. It's a position we're scaling into very gradually, but it's one that I think will actually become more attractive. We think there's some pockets of the corporate market that still look okay, the broader corporate market beyond the front end, but our base case is that credit spreads do continue to widen a bit from here. So we're cautious. We're much more defensive on high yield. High yield has really underperformed over the last few weeks. The market is almost closed to new issues. I mean, there's been a couple of issuers who've had to come to market to finance working capital and things like that, and they're getting penalized really dramatically.
Yeah, we saw that with Carnival recently. I saw Carnival.
Exactly, 10%, 10.5% coupon on that. And those are, to be frank, our retail analysts on the high yield side actually still find some of those names attractive because they are benefiting from the resurgence in service spending that we talked about earlier, people going on vacation. But as an investor in some of these high yield issues, we're a little, as an investor who doesn't have high yield in their benchmark, let me say that, we're a little bit more cautious on allocating to that asset class, particularly right now when growth concerns are starting to pick up. That I think high yield gets punished much more significantly when growth gets called into question. Yeah. And then the only pocket of the market we really didn't talk about is securitized. Securitized, I think, has been a good place to over the last several months to keep cash parked, particularly the asset back side where the spread duration is a little bit higher. It's more floating rate in nature. But I think that trade is perhaps behind us to some degree. Looking at what's priced into markets, I think floaters were the trade over the last 6 to 12 months, but now I think fixed rate is starting to look a bit more attractive. Mm-hmm. And on the agency MBS side, which is probably the largest pocket, of the securitized, we've been pretty cautious just given the biggest investor there, which is the Fed, is reducing their portfolio. And the fact that the second biggest investor, which is effectively the US banks, have also been drawing their portfolio down to some degree as they're increasing lending, actually. So we're still pretty defensive on agency mortgages. It could be something that we add to later this year, but at this moment, it's not an asset class that we want. If we want liquidity, we're going to take it through treasuries, and if we want yield, we're probably going to look to corporates. So for us, the agency mortgages have a fairly limited place in our portfolio.
Excellent. One final question, actually, before I move on to questions from the audience. In our previous conversation, you mentioned that you also do invest or look at least in some local currency bonds, and you mentioned Mexico and Brazil specifically. I know we have many financial advisors from those markets with clients from those markets. Very briefly and broadly, what can you tell us about the local rates market in Mexico and Brazil?
Yeah, so within EM, I guess I didn't mention this one before, so it's glad you brought it up. We've tried to focus on countries with improving trade balances, those that are sensitive to commodities as in terms of being exporters, because we think that will be a more structural trend. Those with stable, shall I say, geopolitical backdrops. And those that have actually been very disciplined when it comes to monetary policy. So I mentioned to you earlier, Mex and Brazil. I mean, the central banks in those countries have been aggressively hiking rates for the last year, maybe even a little bit more than that. The Fed's been hemming and hawing for a while, but these banks have actually been increasing rates in the economy to try and slow down the level of inflation. So from a fixed income investment perspective, I think that makes, looking at those countries where real yields are actually fairly high, makes a little bit of sense. What else? I guess the one other thing is we look at the we look at the level of FX reserves in these countries, they're fairly well insulated. Trade balances are improving. So from a fundamental perspective, they look good. From a valuation perspective, they look good. They're probably at the end, towards the end of their hiking cycles. So I think when you add all of that together, I think that's one place that you can actually find attractive real yields, or more attractive real yields, and potentially could see a cutting cycle commencing in the next maybe 6 months is too early, but maybe 12 months rate cutting.
Yeah, we've seen the debt to GDP ratio in Brazil specifically has gone down quite dramatically, almost by 20%, since the pandemic began. I have a question on that note. Are you monitoring their political risk, local risk there in those countries? Because I know Brazil has a major election coming up, where you have the former center-left candidate Lula looking right now like he might be the front runner, though some of the polls lately have kind of tightened out with Bolsonaro, current president. Any sort of thoughts there, or are you strictly on the macro side there? You're not focused so much on the geopolitical risk?
Well, we do. We have dedicated emerging markets PMs, and I would defer it to them on those specific questions.
That's fine, no problem. All right, great. So let's switch to questions from the audience, and we'll wrap it up there. We're almost nearing our time here. Question: what is your view? What's your forecast for the Russia-Ukraine war? This is a difficult one, so I'm going to throw you an easy one to begin with.
That's the easy one. What's my forecast for the war?
I was being sarcastic.
Okay. What's my forecast for the war? I mean, so this is out of my this is sort of out of my realm of expertise, but I think the answer is probably it's going to be a protracted sort of tragedy that's continuing to play out there. Unfortunately, the fact that this is just kind of going on in the background means that there's going to be continued pressure on the goods that Ukraine and Russia were actually significant exporters on. So the food, the wheat, the energy side as well. We're all kind of Ukraine experts now. Wasn't aware prior to this how much they produce in terms of different like xenon gas and different commodities that are used in different parts of manufacturing of auto components and various other things. So, the commodity side, we were fairly bullish on before that happened. We think structurally there's a lot of support, as countries are committing to various decarbonization targets, a ton of commodities are needed for that. And to get the electrification and the battery power needed, these commodities need to come out of the ground: copper, nickel, etc. So we were fairly structurally bullish on those before, and now this problem has exacerbated it. I think that means there's winners and losers from the war in terms of markets. We're a bit more cautious when it comes to some of the emerging markets that are dependent upon importing food and goods. We think that there could be more political strife, as some of the prices that these countries are facing continue to rise. So I think there are very significant impacts. I think the U.S. is a bit more insulated. So from a markets perspective, we do feel a bit more comfortable there. But the short answer to your question, I think this is protracted. I don't know the exact answer as to how it plays itself out. Perhaps some sort of truce over the regions that were initially being disputed, and then Ukraine doesn't join NATO. But I'm not a geopolitical expert, so that's my best guess.
Of course. Any comments on the syndicated loan space?
So loans are an interesting one. Loans were obviously a great investment for the last couple of years, floating rate, and so they looked really, really attractive. But we're a bit more cautious now, because many of these borrowers in the leveraged loan space have not seen material rise in interest costs that they're going to be experiencing as the Fed continues to raise rates. I think the other problem is that the fundamental side, if growth does turn down the way we forecast, you could also see earnings growth start to turn down, which is a pretty difficult cocktail for some of these borrowers, particularly as we've seen covenants in the loan market really deteriorate over the last I don't know, 12 months or so, because there was just so much demand for loan production. It's not an asset class that we invest in, but it is one that I would be more cautious on, because I think that combination of higher interest costs, lower covenants, and a weaker growth backdrop could pose challenges to the space.
Right. Excellent. And Lisa, this will be the last question. We're 2 minutes over our allotted time, but we'll let this one last in. What's your view on China and those markets over there? Are you, I guess, involved in the bond space at all in China?
I'm not. I wish I had a better answer for you. I'm not. That's not something that I cover, or frankly, I look at particularly closely. So I'm probably not the best person to ask that one to.
Fair enough. Fair enough. No worries. No worries. Great. Well, Lisa, thank you so much for joining us and for giving us now 32 minutes of your time. We went a little bit over, but found the conversation was quite interesting. I hope you all were able to get your questions answered, at least get some views, a different sort of perspective on the fixed income space and markets out there. So again, Lisa, thank you for your time. And Milagros, thank you for putting this together. Have a great week, everyone. Take care.
Thanks, Ahmed.
Thank you. Bye-bye.